Happy Friday, everybody. I hope you all had a great Thanksgiving holiday. It seems like most of the people participating in the markets are still on holiday as the market ended up rallying going into it on Wednesday and then really doing not much of anything at all here today. A little bit of a move in the NASDAQ, but not much of anything else. So we're going to break down kind of this whole week that we've had and how there's some significant divergences that are showing up. So I'm going to talk about why and what that is and why that's significant, why it's important. Everybody's releasing their Black Friday sale. Market Scholars is no different. This is our one time generally every year that we do our discounted sale for our premium subscription. So we're going to show you how to subscribe to that here. So let's go ahead and get started. Today is Friday, November the 25th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or red subscribe button down below. Also hit that thumbs up icon down there to like our video, comment on anything that stood out to you. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, we also wanted to point out we do have our Black Friday sale going on. You can see the bar across the top for all this weekend here, including going through Cyber Monday. You can click this orange button. It takes you to this page to sign up for our discount. Again, this is the best discount you'll ever get. And the reason why is next year, starting on January 1st, the price is going to rise to $34.99 to take advantage, or not take advantage of, but to reflect the price changes. This has been the same price for the last 5 years. So the inflation levels over the last 5 years. So that's going to go up. So basically, this year's discount is not just 20% off. It's actually going to be 33% off of what the price is going to be, again, starting on January 1st. So you're going to want to take advantage of this, especially those of you who are renewing. If you are renewing, make sure you are logged in. You'll see your name already filled in on this. None of the data stays on our server, so all this data is actually coming from our payment providers. Use your Black Friday coupon. Again, no spaces. It's cap sensitive, so you have to do the capital B, capital F. You come down here to where it says have a coupon code. Type in the coupon code right there. You can use PayPal as well. The nice thing about using PayPal is you do get this pay. You can pay over 6 months with no interest. Again, you have to sign up with their PayPal credit, and that's not our. We don't have anything to do with that. But once you've got that set up, then you can go through PayPal and again spread out the payment over 6 months. Again, it works out to be when you get the 20% discount here off of this amount, it works out to be about $66 per month over the next 3 years. So about a 33% discount over what the monthly value is. But you get all of the other things here in addition to what you get for the monthly rate. So again, probably will be the best rate that we will ever have, considering the price increases going into next year. So highly recommend that you take advantage. And if you there's been comments on the YouTube channel from current subscribers. Of course, we always retweet and post tweets from current subscribers talking about the value that they get out of their subscriptions. If you want to get an idea, there's also some posts down in here. Sorry, it's up here at the top. Over here, some of the comments from students when we first started and why they subscribe. So we've had students that have been with us all 5 years. I expect we'll have them staying with us for the next 5 years or however long. We keep on going with this, and you can kind of see why that's the case. Like I said, in addition to all the posts that we typically share on social media. So if you have any questions, just email us at support@marketscholars.com if you're having any issues at all subscribing. Again, if you are a current subscriber and you're looking to renew, then you just have to make sure you're logged in. So click that login button that's over here, and like I said, to confirm you're logged in, you'll see your name already posted here. Fill out the rest of this. And again, like I said, if you want the 6 month no interest, you have to use the PayPal option after you log in and apply for their PayPal credit there. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. As you can see, the intermediate line is up in the upper reversal zone, easily in the upper reversal zone. It's actually up in above the 90th percentile. The near-term line also making its way. What the one indicator that did not make its way into the upper reversal zone is the momentum line. So you can see as we've been rallying here on this near-term rise, the momentum line never really jumped up, which means we never really got strong ranges closing near the top of the range. That's what gets the momentum line up to these really high levels, or big moves closing near the highs of the day. That's, those are kind of what you want to see to start those near-term rallies, and that's not what we've gotten so far. Even though we had a pretty decent move there, but it wasn't necessarily a bigger range. It's actually a pretty relatively small range that day. So that's what kept the momentum line down, and it was even worse actually on the Dow Jones Industrial Average. And you can see the big difference there. Again, big ranges are what get us going, and we don't really have that going here. Again, we kind of saw that kind of discrepancy at the very tail end of the mid-August run. It's a very similar move to what we're seeing in mid-August. Despite that, you still do have dark green shading the green line across the board on the S&P 500. On the Dow Jones Industrial Average, which has been the most bullish, well above the high over 5.75%. The NASDAQ 100, dark green shading and a green line, and then your Russell 2000, dark green shading and a green line. Even though they were kind of briefly light pink shading, because that near-term intermediate line had dipped, but it's back up here. And again, you can see same thing for the Russell. The near-term lines made it into the upper reversal zone. The momentum line did not. If you look at the S&P, and especially the Dow, so it's the NASDAQ. Again, the near-term line follows the momentum line. So if the momentum line is going to drop down there, you expect the momentum line to follow suit. Or excuse me, the other way around. If the momentum line falls down there, you expect the near-term line to follow suit. And you can see the NASDAQ cannot quite get above these resistance levels, even if the S&P and the Dow really have. At least the S&P is kind of breaking through and getting up to those levels there. So pretty decent run, but not necessarily supported by a good, strong move. Not surprising, this has been a holiday week, and that's the kind of move you get in these holiday weeks. If you take a look at the weekly chart, you see the same phenomenon. Again, the near-term line getting into the 90th percentile, but the momentum line is dipping its toe. Again, we saw that in August. We saw that in May and June. Not quite in March. They both got up there, but these other instances were the same phenomenon. So again, that's not, even though the intermediate line has crossed above market sentiments, out of bearish territory, you're not quite above the 2.5% mark. This is the chart you would like to see the S&P have. The intermediate line in bullish territory, dark green shading the green line, well more than 2.5% above the 30-day moving average. If this were the S&P 500, and the momentum line did get into this area before the near-term line did, if this were the S&P 500, we would be like all Tom Lee fans, right? We would have a picture of him in our offices. We'd be ready to go for all-time highs. But the fact that it's only a Dow that's doing it, the Dow is 30 stock index, hand-picked, supposed to represent U.S. industry. It's a price-weighted average versus a 500 stock, passively constructed, market cap-weighted index with the S&P. That's the fact that we're not getting that to look like this shows that it's, the Dow is really just a handful of companies that's showing some relative strength, and it's producing a good pattern that we're just not seeing anywhere else, and we're especially not seeing in the Russell. Look at the Russell. The momentum line did not get into reversal zone at all. The near-term line barely dipped its toe. It's already dropping. Market sentiment line still down there. You got a green line, but you don't have dark green shading yet because we're not above 50. Close. But we're also below these really important support levels. The Russell just can't get going. So again, you see that it's kind of the NASDAQ's not even close to being above. It's still easily below its moving average, which is red. The momentum line did take off up there, but now it's down into lower reversal zone, which means we expect the near-term line to get down and follow suit down there. So you can see the setup that we have going into next week. If you take a look here at the other weekly chart that we look at with the Hakinashi candles, you can see that the S&P is close to getting, and you did get a higher close. It's got a rising PPO, so the gap is shrinking. We're not above that 40-week average yet. The NASDAQ 100 is not even close to it, and actually got a slightly lower close, so that the NASDAQ and the Russell, for that matter, too. The Russell also got a lower close. they're actually both setting up for a bearish candle next week. This is kind of a transition slash kind of a reversal type candle. So we'll see if that actually plays out or not. The Dow Jones, on the other hand, was actually really bullish this week. Again, it got the crossover. Man, again, if this were the S&P 500, we'd be ecstatic. But it's not, unfortunately. And again, you can see we've been above the 40-week. We're above the 40-week far enough that the 10-week is crossed up above. Even if the candles are getting smaller, we did close above last week's high point. I mean, that's about as. I mean, again, if this were the S&P 500, we would be all aboard that bullish train, all aboard it. But it's not, right? It's not the NASDAQ 100, which is also market cap weighted, passively constructed. And it's not the Russell 2000. It's, it's a 30 stock index. It's price weighted, and we're seeing the impacts and divergence when you have that type of average relative to the other market cap weighted indexes. If you take a look here at some of the other charts, so let's look at the 3 green arrow charts. Your S&P and your NASDAQ both have 3 green arrows again. Your Dow, as bullish as it is, and the Russell do not. They still have the red arrows and the MACD. When you look at them on the 2-line versions like this, the S&P is right up against the 200-day moving average. The Qs are nowhere near it. IWM is also right up above the 200-day moving average. 30 days crossed the 50 for the Russell. The NASDAQ, the 30 days also crossed above the 50. For the diamond, the 30 days actually crossing above the 200. And so then you have your spiders in between. Spiders, you got a pretty decent move. The MACD is still above its moving average. Everywhere else, the MACD is still below its moving average and converging. The S&P has also got the phenomenon along with the Qs where we're at the point of control. Slightly above it, but pretty much at that point of control, trying to figure out a way to burst through it with all this other Fibonacci resistance as well as a momentum convergence going on. It's really hard to break through resistance when you're in that kind of pattern. With the momentum line on the market forecast not getting to the reversal zone, reflecting bigger ranges closing near the highs. So it's kind of like a thrust move. That momentum line is giving you kind of a thrust signal that we're bullish enough to maintain a near-term run. And right now we're not getting that thrust signal to maintain that. Let's look at some of the other oscillators here. We're still got a very good bullish DMI. The diamonds really, really bullish. Like the ADX is really high. It shows, again, just how strongly bullish that is. The Qs, on the other hand, you're below 30 on a positive indicator, and then you can see the IWM, your negative indicator, is actually still above 20 with this ADX still really, really low. So there's no trend going on at all. You can see that reflected in the trend strength indicators. IWM just has a very, it's got an intermediate trend strength going, but it's not very strong relative to the diamonds, which is insanely bullish. And then you have your Qs, which have no trend going at all, and you're stuck in the cloud. Again, these are the biggest companies even in the S&P, and you see where they're stuck at right now. And then finally your S&P 500, you can see as well, trying to get some kind of trend going, being up above the cloud there. With a pretty good relative strength or a rate of change over the last 6 days still showing up. You're still flirting with that 60 level. You're also flirting with a bearish divergence on the CCI down there. Your NASDAQ 100 is not even above 60, and it's giving you that lower high point kind of stuck. At least they're both above 50. Your Dow Jones Industrial Average, you are above 70, right? So you got this kind of extreme RSI range again that we've seen multiple times before, and then your CCI is also setting up divergence there. Your Russell 2000 not above 60 and not above, still above 0, still above 50 at least, but not that bullish. So you can see kind of where the strength is and where it's not. Your Bollinger Bands, you're flirting with the lower end of the upper quartile, but at least you're still up above there. The Qs, you're not in the upper quartile, and your IWM, you're barely not either. The diamonds are just killing it, still in the upper quartile with a falling bandwidth, still up above the Keltner channels. When you look at the Keltner channels there, you can see how the diamonds are rising above the Keltner channels, whereas the S&P hasn't been above it except for one day above its Keltner channels, right? And and the other indexes like the Qs are nowhere near the upper Keltner channel, and neither is the IWM, which actually has its bands inside the Keltner channel. So it's really just a Dow Jones Industrial world that we're living in right now, and nothing else is following suit. In fact, the S&P has been flirting with breaking its moving average. It is back up above it, but it's been flirting with breaking its moving average there. If you look at the NASDAQ, its moving average is actually lower, and the Russell 2000 is still below its moving average on the stochastics. Of course, the diamonds, the moving average is extremely high, and we flirted with breaking below that one as well, as we're kind of diverging on this. I did want to show the McClellan oscillator. So the McClellan oscillator did get above 50, so we've had a good few days here, the last few days, to get up, so we're up above 150. So we're working our way back up towards 500. If we can, it'd be nice if we can get some kind of thrust here. You can see the move here. Let me make it look more like it actually is. I mean, still a pretty good move there on the Dow without a thrust above 100, coming off of a low that did have a thrust below minus 100. So that's the issue that you're getting, and we're not seeing strength in the markets. If we looked at the Hull moving average previously, you can see the diamonds are back up above it and flipped the parabolic SARs down. Your S&P 500 has been below the Hull and is barely at the Hull right now. And you can see its PPO here. This is relative to the 200-day Hull, how high it is with no momentum going on here, even if you're getting higher closes. Your Russell 2000, not so bullish. Your Qs, not so bullish. In fact, your Qs are below the Hull. Again, the more we stay below the Hull, more likely it is to turn red. So, and again, you can kind of see again the setup where we have going into next week's chart with the volatility index really, really low, the lowest it's been since that mid-August run. We're still above 20. But the VVIX also really low, down towards 82. Volatility is really compressed. That's continued to be the main theme, is this tremendous compression and volatility over the course of really for most of this year. When you look at how volatility compresses, we've really compressed here down to these low levels, but we're still, most of these other times we get down here are on peaks rather than low points. So that's kind of the issue that you're seeing here. When you look at it on the weekly, you can kind of see, just like we did in mid-August, where we had 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row where the VIX dropped. We've been on pretty much 1, 2, 3, 4, 5, 6 week, 8-week run here, if you count these two small gains in the VIX where we actually had gapped up and fell throughout the week. That's why they're filled in. So it's not necessarily red, but they are all filled in candles here, which means we've closed lower than the open of that week. The red ones being we've closed below the week before. So it's a very small range, as you can see up there, right at the highs. We did not get a new high today, but we're pretty much right there. We're not going to get a new low point anytime soon. In fact, we're getting to the point where that low point, we're dropping back down. It's got to get to 0 before it would ever spike to 100. The green line's got to get below 70. So as long as we continue to kind of push up to new highs, we don't have to worry about that spike. So we'll kind of keep our eyes on that Arun indicator for the S&P. For the Qs, the green line is below 70. The red line not necessarily to 0 yet. IWM, also the green line is below 70. Again, no new high, is below 70 there. Of course, your diamonds, we're just at 100. We got a new high this, every single day this week. So you're not below 70 at all. So this is, again, you can kind of see, the Qs and IWM are kind of set up for a period of weakness. If you look at their 4-week ranges, again, that low point's got to get all the way over, but you can see as this low point gets over here, you're actually still going to have a low point right there. But barring a new high point and we start trading in this area and continue to fill in some of that gap, you can see how close we would get to a new low. And the same thing with the Qs. Once this gets over here, then we'll move up a little bit, then we'll really move up, right? If we don't push through to new highs sometime before that. So we got about another week and a half, maybe 2 weeks before, about a week and a half before we get to that scenario. We got a week and a half that these two indexes pretty much need to get to new highs like the other large caps. If we don't, if we end up next week with a lower high and a lower low relative to the week, this week's high and low, then you can see what, the kind of move. But if we follow the Dow's pattern, if we follow its trend, then we can really make it into the end of the year and into the beginning of next year on an upward swing from a technical perspective. All right, now let's talk about what's driving the price action. So for this week, again, really, really light week. If you look at the sector, let's go to the asset class comparison first. So we'll look at how the different asset classes have performed. And let's go over here to November and then 21st. So here we go. And then we'll come out to like a 10-minute. Right, you can see that the S&P was relatively bullish, but what's interesting is bonds were really bullish. Bonds had the biggest move of the week among all the major asset classes, which means yields were down for the first time in a while. Commodities were down, and the dollar was down. Remember, that's been your three-headed monster this year, is bullish commodities, bullish dollar, bullish yields. And they all three were down. In fact, if you look at the 10-year yield here, for the week, here, let's go to this chart. If you look at the 10-year yield, you can see that got a red arrow on its 10-week moving average. We actually closed below 3.7%. Remember, the Fed, when you look at the Fed's rate hikes pattern here, let me refresh the page. Give it a second here. Here we go. So we have 100% odds that we'll be at 450. Remember, the 10 years at 3.75, below 3.7. We have 100% odds we'll be at 450 by December 14th. We have 100% odds that we'll be at 475 in the February meeting, and we have a 70% odds that we'll be at 5% in the February meeting. And if you look at, again, where those odds have been for February for the 5%, this green line has been above 80 multiple times. You're usually getting above 80. It generally, you can see like the green line here. You can see how it made it above 80, pulled back, made it back above 80, pulled back, made it back to, pulled all the way down to below 20. This was the 3.75%. Back earlier this year for February, and you can see it gets to 100, it stays. It gets to 100, it stays. It gets to 80, it pretty much makes its way to 100 eventually. Will make its way to 100. So the purple line, which is 5% by February, has made its way to 80 multiple times. It will more than likely make its way to 100 by the time we get to the beginning of February, first day in February there. So again, the 10-year yield at is below 3.7. So we're and the 2 years not going to drop, right? The 2 years is going to make its way because that's what these short-term price in that action. So this is already at 4.5% for this next meeting. The 3 month is going to work its way there, gradually work its way there, and then it's going to work its way up by February up towards 5%. And so they're not going to drop. And if the 10-year stays here or declines, then you're looking at a yield spread which is already relatively low at 0.78 basis points, as you can see, going all the way back to the 80s to 1980. It's already pretty low, and I can go back further here on this one. Let's add the 10-year and the 3 month. We'll add that on there. Okay, and then we'll just show B. So this is, let's actually do, I already have the 3 month in there, sorry. Let's do the edit graph. Let's add on the 10-year minus the 2 year. There we go, add that on there. So again, B, this is the maximum history we have. So, look back to all the way over here. You have to go all the way back to the early 80s to get a yield spread this low. It would be, right now it's at 78 basis points or whatever it is. It would have to get, it would be at 130 plus basis points, assuming we get to 5% and the 10-year stays below 3.7. So it's going to be at least 130 or more, unless the 10-year rallies, right? There's two ways to make this yield curve jump back up to zero. You'll either get the 10-year rallying or you'll get the Fed cutting rates. And we know the Fed's not going to cut rates. The Fed's not going to cut rates anytime soon. So more than likely, in fact, if you look at the historical charts here, so again, expected to get to 5%. If you go out to June, the 5.25%, which is now the purple line, also got above 80 and is above 60. So pretty good chance we'll be at 5.25% by June. That seems to be the terminal rate. You'll hear that a lot. It seems to be the terminal rate, 5.25, at least 5 to 5.25%. If you go out to December, you can see right now the purple line is the 4.75% mark, right? That's the purple line, which has not quite, it got above 80 over here. It's not quite above 80. 4.5% is. So by the end of next year, the market is pricing in that will come back down from 5.25 down to 4.5%, if not down to some of these other levels here. So it kind of goes to show, like, the market is expecting the Fed to start cutting rates late next year, but not anytime till then. So you're going to have and I would highly doubt we'll even get that because, again, when you look at the CPI, the real CPI, which is what they said they've been watching, if the CPI continues to drop at its current rate, right, we will get down to a flat, a 0% real effective funds rate in about June of next year. So again, where if we peak at 5%, and then we won't get to a 2.5% mark if the CPI continues to drop. We won't get to a 2.5% mark if it continues to drop at the same rate it rose until the end of next year. And again, the Fed says they want to get it there, but they want to keep it there like they did, all the other rate hike cycles, and especially in the 80s, they actually got up to 5%. And that's if the CPI continues to drop. Remember, the unemployment rate's not rising. So as long as the unemployment rate stays low, the CPI will drop for a period of time, but eventually it's going to stop dropping and turn back up as long as the CPI, as long as unemployment rate stays low. And it's never happened before where we've gotten above 5% on the CPI and we haven't had a rise in unemployment. So if we do end up getting a rise in unemployment, then you can see there's your recession. That's what every single gray bar here, gray shaded area, has been associated. So again, we haven't even started the recession yet, and we've got this level. So we're susceptible to a double peak on CPI unless unemployment rises, and if unemployment rises, we're susceptible to finally the beginning of a recession. And that's when the yields. That's what eventually you get to Fed cutting rates, and when the yield spread rises. So this is the yield spread. Remember, when the yield spread rises, that's actually bearish. Like you can see every single one of these areas when the yield spread rises is actually associated with recession. So we technically don't want the yield spread to rise, but we also don't want an inverted yield curve. It's not normal, it's not natural for you to be able to get 4.3% over 3 months versus 3.7% over a year, right? Of course, nobody in the right mind would buy a 10-year bond right now. They would instead buy a 3-month bond and just roll that over. So eventually, that's how they change, right? So usually that means that people will sell bonds, these long-term bonds, to buy those 3-monthers, and that's what will make the yields rise here, unless the Fed cuts the short-term rates, which we know, again, that they're not going to do. All right, let's take a quick look at how the sectors have been performing here this week. So bear with me 1 second to bring that up here. So November. And then we'll look at just this week alone. It's a really quiet week, right? Well, it's been utilities, it's been materials, it's been financials, it's been staples, it's been industrials. Again, your three big winners started the week off poorly and then finished the week underperforming. Still up for the week, but underperforming. And XLE, which has been your biggest winner by far, has just really been your biggest underperformer. So, again, it's not necessarily, usually I'll tell, here, let me go year to date, and let me show you something here. This is why I broke down for our market scholars. When you have a decline like we've had, usually your biggest losers during the decline are your biggest winners during the rally. And your biggest winners are your biggest losers. So if you look at when we started this move, so starting on August, we peaked on August 16th, and then we bottomed out here on October the 12th. So if you look at how we perform from August the 17th all the way down to October the 12th to that low point, you can see the biggest losers were technology and real estate and industrials and communication services and consumer discretionary. You would expect those to be the biggest losers. Energy actually gained over that time frame, was up 4%. Healthcare, staples, and then you also see industrials, financial, and materials. They still had declines, but they outpaced the broader market. Because again, you're big. So you would think, okay, utilities and real estate, because as we rallied, yields have been falling down below 3.7%. So yields have been falling. That should put utilities and real estate up. And then XOK, XOY, XOC were the biggest losers. They should be the biggest winners. So if we go now from October the 13th, the next day forward, all the way until now, here we go, all the way to today, that's not the case, right? It's been financials, industrials, materials have been the biggest winners. Communication services and discretionary have been the biggest laggards. And you can see real estate and utilities, slight outperformance, so it's been kind of relatively recent. Not the big gains you would expect to see from the areas of the market that were by far the biggest losers. And so again, that kind of goes to show what this rally's been all about. It's been in energy, you can see again, which was a winner. You would think it would get back those gains, but it hasn't. It was actually one of the biggest movers along with these other areas during most of this rally. So not the kind of rally you would expect us to get coming off of that decline, the previous decline. And again, goes to show like this is mostly a Dow Jones type of move, and not the type of move that you would expect would continue. Let me just kind of let me show you what I'm talking about there. If I were to go to Market Watch and go to the public and look at the Dow Jones Industrial Average, you can see from a market cap weighted, it looks like I don't have the market cap weighted here, so let me bring up market cap. Here we go. So if you look at, again, this is a price weighted average. So the biggest companies, the biggest movers, according to the biggest influences on the average, according to its price weighted, is these companies. You can see Home Depot there, Goldman Sachs. I'll move this over here too. I need to get rid of some of these. Don't need those really. And I'll bring this up. There we go. So you can see Goldman Sachs, Home Depot, United Healthcare, Amgen. I mean, those have been your biggest. Caterpillar, which has been doing well, Honeywell. You can see like Nike and Disney are down here at the bottom, along with Apple. Apple used to be way up here. In fact, if you look at Apple, is your biggest market. It's still over $2 trillion market cap. Microsoft is closer to the top. It's at 1.8 million. Those are your biggest market cap. But then you notice, if I look at like Goldman Sachs, it's down here at the bottom of the list. Caterpillar is down here at the bottom of the list. Travelers, Honeywell is down here at the bottom. Apple, Microsoft, United Healthcare is up there. But you see how we're missing a lot. Like United Healthcare is the third biggest market cap weighted. It's the number one biggest influence on the Dow from a price weighted standpoint. But if you look at like the S&P 500, here we see S&P 500, and you try to find United Healthcare up here, and I don't know why you're not seeing that. All these old other companies up there. But you try to find United Healthcare, it's right here. So it's underneath Apple and Microsoft and Amazon and Alphabet, right? And you can see some of these other companies like Meta has really dropped down. Tesla, there's Nvidia is down. Where did Meta drop down to? Let's see, Meta is down. which had been right up there, right? One of the bigger companies. Where did Meta? There's Netflix way down here. Let's see if I'm totally missing it. Meta is right. Oh, it's not on the list. Here, let me see if I can't. Because it wouldn't be still under FB, would it? Oh, it shouldn't be. So this list, for some odd reason, is not updated on there. Here, there we go. This is that must have been an old one. There we go. So there is Amazon and Alphabet and Tesla. There's United Healthcare, right? There's Nvidia. Meta is way down here. Now it used to be at the top, and it's only at 250. It's below Coca-Cola and Pepsi now. So you see how, you know, we got 5 companies, Apple, Microsoft, Amazon, Google, and Tesla, that are all much bigger, or slightly big, at least slightly bigger than United Healthcare. But see, they're not listed in the Dow Jones at all, and they have an even bigger influence on the NASDAQ 100, right? So your NASDAQ 100, these stocks have an even bigger influence on that, and you know, it's just it's a different part of the economy that's leading us higher, and it's not the part of the economy that's necessarily. I mean, you can see all these are all red here today. Your biggest winners here today. You have a few different stocks in here, but they're all kind of retail type stocks and kind of reopen type stocks, but not your big market cap weighted. Microsoft is the only one that was only slightly negative on the day today. That was even close to, that was at least over 200 million. Costco would be the next one. That was over, only other one in this top 25 list that's over 200 million, and it was down today too. So you get the idea, right? You get the idea of what's driving the market, and it's not, you know, this areas are not the kind of things that would lead a charge higher. If you look at this index, this chart here, the average of how the Qs are performing relative to IWM. And you see we've had a nice little run in November where the Qs have outperformed, but it seems to be like we're kind of stalling. Momentum, the MACD histogram's already peaked. Usually the MACD peaks after that. And you can see the CCI peaked without getting up above 100. The RSI peaked without getting above 6, or at least appears to be peaking. So you get the idea that we're not really, you know, the new highs and new lows index did get to above 0, but it's barely above 0 there. At 27, the skew index really jumped up today. Now again, that might be a kind of a Thanksgiving kind of a scenario, but you can see it also jumped up at the peak there. This is one of your bigger jumps. The MACD is really peaking here. Again, when it peaks, you notice when the MACD peaks on the skew, generally the S&P, which is the black line, also peaks along with it. You can see all 4 of these peaks at these momentum levels have all peaked around the same time. So it'll be interesting to see if this skew is kind of a phenomenon of a half-day trading, or if it's telling us something that we've seen before multiple times this year. All right, now let's take a look at what's our trade idea today. Excuse me. And we'll look at Penn National Gaming. You can see its near-term line came out of bearish territory, but already peaked. And is moving back down. The momentum line obviously did not get up very high either. Again, this is kind of like what you typically see. We're dropping down towards the moving average. You can see light pink shading developing there. If you take a look at the weekly chart for Penn National, you can see we've got a lower close this week after some really good bullish candles getting up to the 40-week moving average. We got a lower close setting up for a transition candle. If you take a look at the 3 green arrow chart, obviously we do not have 3 green arrows. We have 2 red arrows, and that's continuing to be the case. When you look at this chart, you can see we're hitting up against that 200. The MACD is well below its moving average, some significant momentum to the downside. The stochastics is out of bullish territory. You know, we're kind of converging here at the 200-day moving average and working our way lower. If you look at the weekly chart, you can see we've basically that long upper shadow right at the 50-week moving average, and the MACD peaking and rolling over, the histogram at least. You can see how we are kind of setting up for a leg lower right now. Looking at the DMI, we've been so bullish, and now we're not. The negative indicators back up above 20 there. Looking at the RSI and the CCI, you can see we are below the zero level on the CCI, coming back below 60 on the RSI. Looking at the Bollinger Band, so let's look at the Ichimoku cloud. So we had this bullish trend going. We're not mature bullish anymore. We're back below 80. We're back below 5. Never did really get above 5 there. We're below the green line on this. Finally, looking at the Bollinger Bands. You can see we are back to the midpoint of the chart here. So we're not, we are not nearly that bullish anymore, and we're starting to kind of converge and work our way lower. So what we decided to do here is say, okay, well, let's take a look at its options for December expiration, and we will sell a 37.39 bull put spread. See if we can get that 47 cents on this, and we'll put it out to a full position size. If I analyze this trade and set my slices to the break even and put that onto the chart, you can kind of see where that break even is. So essentially we have to get back above that volume node for us to take what we would like to be only a $329 loss for the $1,000 of risk that we're willing to take on this. So I'm going to confirm and send, stick that into our market outlook category, and send that through for Monday's open. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have, or apply to anybody else's thread. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Join our website. Remember our Black Friday sale here. Again, very unique. Last time we'll have this much of a discount, considering the price is rising up here for the beginning of next year. So we look forward to joining a lot of you in our community going forward into the end of the year here. Have a great rest of your Thanksgiving holiday, everybody, and we'll see you all next time.